Good morning and welcome to the Killik and Co Market Update. The main focus this week has been the escalation of the situation in the Middle East, and there certainly has been some concern about what will happen next following the assassination of the leader of Hezbollah and the missile attack on Israel by Iran. Previously, when there has been unrest in the Middle East, we have witnessed a spike in volatility and also a rise in the oil price. And what's been quite surprising this time is that neither of those things have happened yet to a particularly big extent. Here's the VIX index, also known as the Fear Index, which is a measure of expected future volatility. When the level of the VIX is between 20 and 30, we would consider that to be elevated and an indicator of high volatility. This is a 10-year chart, and it's dominated by that massive spike in 2020 when the world went into lockdown. Let's zoom in a bit and look at the one-year chart. There was a spike in early August up to a level of nearly 40, and that was when the Japanese central bank raised interest rates, causing Japanese equities to drop 12% in a single day, and the impact of that spread across global stock markets. The VIX today is just over 20, so just about creeping into that 20 to 30 range, but not yet showing an extreme level of fear. Moving on to have a look at the oil price, here's Brent Crude over the last 10 years. There was the drop during lockdown when people weren't allowed to travel and oil demand fell, and the spike in 2022 when Russia invaded Ukraine. There have been some headlines this week about a surge in the oil price, but the price is still down 9% on a 12-month basis. One reason for the lower oil price is the lack of demand from China. China is a big importer of oil, but its economy has slowed in the last couple of years, and that has led to a lower need for oil. This chart shows China's oil imports since the year 2000 up to the year 2022, and there has been a notable decline since 2020. The other issue causing a lower oil price could be the expected increase in production from Saudi Arabia. The kingdom has been keeping its production constant at around 9 million barrels per day in an attempt to reduce the global supply of oil and prop up the price. However, this hasn't really worked, in part because the US is now producing so much oil, and Saudi Arabia doesn't have as much impact on the price as it once did. Last month, the kingdom announced a new plan to raise production to try and take market share, and this higher supply will weigh on the price. Earlier this week, a US port strike began involving 45,000 workers across 36 ports across the East Coast. These ports are a crucial part of US trade, and the strike was costing the US economy $5 billion per day. The workers' argument was that the shipping companies had made huge amounts of money due to the rise in shipping rates following the pandemic, and that they hadn't shared enough of these profits with their workforce. Here's a chart showing the earnings of Maersk, one of the largest shipping companies in the world, over the last 5 years. You can see the earnings rose eightfold between 2019 and 2022. Fortunately, a deal was agreed to end the strike yesterday, which will come as a relief to the US economy and to many individual companies in particular. Here are some of the biggest users of the ports. Walmart shipped over 47,000 20-foot containers last year, and IKEA was next on the list with just under 43,000. An extended strike could have led to supply shortages and therefore a rise in prices and inflation, so the quick deal will be good news to the Federal Reserve as well. Lastly, we talked about the rise in Chinese equities last week following the new stimulus measures announced by the central bank and the government. The positive market reaction has continued into this week. Although Chinese markets are closed for Golden Week, the Hang Seng Index in Hong Kong has continued to rise. Here's the index on a 5-year basis, and you can see that notable spike at the end. We also saw a rise in the Fidelity China Special Situations Investment Trust, which contains Chinese equities but is listed on the London market. Here it is over the last 5 years, and again you can see that big increase at the end. The discount on the trust has also narrowed from a low of 13% to 9.3% today. This one is covered by our research team, so please do give us a call if you'd like to chat about it in a bit more detail. Moving on to have a look at next week, we are expecting results out from Shell and from JP Morgan. That's it from us. Have a great weekend, and we'll see you next Friday.